Hey, check this out. According to Finviz.com, there are 5,413 global dividend-paying stocks, but most of them are not worth your time or money. What's going on? I'm Russ, and I've been dividend investing since 2018. I made many mistakes when I started, and I want to share with you my top 5 beginner dividend investing mistakes for you to avoid. Mistake number 1, not understanding dividends. A dividend is the annual dividend payment divided by the stock price. Some businesses, especially mature ones like Coca-Cola or Procter & Gamble, issue dividends to their stockholders because they don't have a good way to spend all their profits. And when you buy a stock, you become an actual part owner of the company. So how do you get this dividend? Well, a super duper easy way to check, you can go to seekingalpha.com, and this is incognito mode, so this will work. And in the bar at the top, just put the company name, it should populate. You'll see the symbol. Ticker KO, will use Coca-Cola. And by the way, if you want to save a bunch of money on an annual Seeking Alpha subscription, I have an affiliate link below. And then if you scroll down again, you will see the dividend scorecard. And what we are most concerned with here is the ex-dividend date. And if you get lost, hover over the name and a bubble will pop up telling you all about it. But for Coca-Cola, it was June 14th, 2024, meaning that if you want the next dividend of 49 cents, you will have to own the stock on July 14th when the market opens. So just think of it as you need to own the stock the day before the ex-dividend date if you want to receive that 49 cents per share on July 1st. You cannot buy on or after June 14th. You will have to wait until the next dividend cycle. And one more thing to note, dividends are not free. So when the stock goes ex-dividend, ex meaning without, you will see Coca-Cola's share price open up at a minimum of down 49 cents per share because they have to pay out the dividend. But because it comes from profits, if the business does keep earning money, this is not a problem and this is normal. Mistake number 2, chasing high dividend yields. A high dividend yield doesn't always mean it's a good investment. Sometimes an extremely high yield can be a sign of trouble, and some companies pay or raise dividends to lure investors when they really can't afford it. So yields between 3 and 5% are good, but anything that's above 6 to 7%, you're really going to have to research why the dividend is so high. So some businesses like Realty Income, ticker O, and Agree Realty, ticker ADC, these are called REITs, Real Estate Investment Trusts, or Enterprise Products Partners, ticker EPD, and Energy Transfer, ticker ET, are called Master Limited Partnerships, or MLPs. They are built though to pay higher dividends to their investors. These REITs and MLPs must pay out 90% of the money they make in dividends to the people who own their stocks, but know that you are going to pay your regular ordinary income tax on those dividends. Mistake number 3 is thinking that dividends can't be cut. Companies can cut or eliminate their dividend if they're in any kind of financial trouble. And believe me, just because a company has raised its dividend for many years does not mean that they will absolutely continue to do so. That's why the saying, past performance is not a guarantee of future results, is so meaningful. And things that have never happened before happen all the time. Now, AT&T was a dividend aristocrat, meaning that they were a stock that had increased its annual dividend for at least 25 years, but they cut their dividend after 35 years of dividend raises. And a dividend king has raised its dividend for 50 years in a row, and 3M was a dividend king that cut their dividend after 60 plus years of dividend raises, and Leggett & Platt, ticker LEG, and VF Corp, ticker VFC, were newly crowned dividend kings when they each cut theirs. So please don't make the mistake of assuming that a silly name like dividend aristocrat or dividend king means that the dividend is safe. Mistake number 4, ignoring payout ratios. Look at the payout payout ratio, which shows how much of a company's earnings or cash flow is used to pay dividends. Ideally, it should be below 60 to 70% because most of the time, a higher ratio could mean that the dividend is unsustainable. I like using the free cash flow ratio because that's where the dividend is paid from. Now, REITs use the AFFO ratio, which is the adjusted funds from operations, and MLPs use the DCF ratio, which is distributable cash flow. And with banks and utilities, we look at the earnings payout ratio instead. If all that sounded like a bunch of gobbledygook, don't worry, just the simple fact that you are now aware of payout ratios and that there's a little bit different for some businesses will put you miles ahead of where I was at when I was in your shoes. Now, SimpliSafe Dividends is a service that requires an annual subscription that's probably a little bit pricey that I like to use, but down in their financials, they show the free cash flow payout ratio, which of the last 12 months looks to be about 65%. But if you head on over to finbox.io, I found that for free, and as we say, if it's free, it's for me, they show Johnson & Johnson's latest 12 months free cash flow payout ratio is 64.1%, so very, very close to SimpliSafe's 65%. So remember, when you see a payout ratio that's over 70%, think of it as a red flag, something that you're going to have to be very careful and cautious around, unless they're tobacco companies or they're designed or built to pay out those high ratios. But this is a good rule of thumb that is most, but certainly not all cases. Mistake number 5, focusing only on high yield, especially if you're young. If you're young, it probably makes much more sense to prioritize high growth dividend stocks over high yield dividend stocks because growth stocks have more potential to increase in value over many years, making your investment much larger by the time you retire. Established large companies can often pay higher dividends because they're not reinvesting as much into growth opportunities. But younger businesses that are still expanding tend to keep more earnings for growth, which usually leads to lower initial dividend yields. So although not always the case, these growing companies can potentially increase their dividends and stock prices more rapidly over time than most high dividend paying businesses with limited growth prospects. So again, if you have a long time horizon, it probably would make more sense to think about high growth, low dividend yield stocks over high yield, low growth dividend stocks. So remember to do your research. Don't just chase high yields. Everyone will have roughly the same data, but the most important thing that not everyone has is knowing what that data means. And that's what you'll need to find out. I think a quality dividend growth investing strategy is the way to go. And if you would like help with being a better dividend investor, a friend of the channel, Mr. Fabio Marciano, who is a multi-millionaire author of the book Dividend Millionaire, The Proven Path from Zero to $100,000 in Passive Income, which you can check out his book for sale in the video description for more info. Well, in this floating little box next to my head, Fabio and I had a chat about his story and about his book and who he's trying to help. So if you click this floating little box next to my head, we will see you there.